Welcome to Tangent Proptech, where real estate meets innovation and goes a bit off script. I'm Edward Cohen, Proptech entrepreneur and your host, alongside my co-host and Proptech venture capitalist Zach Aarons. On this show, we bring on a guest who's shaping the future of real estate. We dive into housing innovation, climate tech, the future of work, and everything transforming our buildings and cities. If you work in real estate, proptech, development, or if you're just obsessed with making buildings and cities better, this show is for you. Welcome to Tangent. I'm Edward Cohen.
And I'm Zach Aarons.
Today on Tangent, we have Moshe Crane, writer of Curious Deal newsletter, host of the Curious Wire podcast, and VP of Sage Ventures. Hi, Moshe. Where does this podcast find you?
Hi, thank you for having me. I'm in Baltimore, Maryland.
So before we step in, I just want to say to everyone that truly an honor here, Moshe, to have you as a guest, because you've been persistent and insistent, and we're just not used to this level of desire to be here with us when someone is more popular than us.
Yeah, this is a bona fide podcasting celebrity we have on our program today.
We all learn a lot from you, but for those that don't know you, and before we jump in to talk about all the good stuff and the less good stuff happening in multifamily these days, what's going on with tech and AI, and how you've built a wonderful platform in multifamily and overall real estate communications. So for those that don't know you, tell us quickly about your background.
I started in commercial real estate, actually working for a company called Bico, leasing office and warehouse space. I did that for about 2.5 years. Then I was working for a supplier, wanted to get back on the real estate side. I never thought that I would be in multifamily. I thought Sage was just going to be a pit stop that was my foot in the door back on the owner side, and that would take me somewhere else. And I fell in love with multifamily. And yeah, when I started, we were at 1,800 units. Now we're 5,000 plus. Our core business is buying existing multifamily, and we have a development arm as well. So we'll buy land and build townhomes or condos, and those are sold individually. We accidentally got into self-storage. We have now actually bought some office, and we are now seeing multifamily deals come back as well.
What do you mean by coming back? Cap rates?
The ability to buy. So thank God all of our deals have been performing. It's just been very difficult to buy new deals. We did a preferred equity deal at the end of 24. We did a true transaction at the end of 25, and there's a lot in the pipeline activity that's going on now.
And is that because people are finally just saying we're not going to pretend and extend, or is that the preferred equity coming back, or sellers getting more realistic? What's driving that?
A combination of all those things. So a lot of the deals that we're looking at right now are folks that have struggling properties that they would prefer to sell, but they're not going to get the price that they want. So we're not in the third party game, but they are coming to us saying, can you put a piece of equity in here and take over so that we could get this to a place where we could sell it where everybody's happy? And some of them are just people coming down to earth. We just bought a development deal where someone bought in 21 for a lot of money, and I guess they just delayed, and we bought it at a fraction of what they did. And we're building a 316 unit development downtown Baltimore. So a combination of different things of they've been extending, they're struggling, but they can't sell, or people coming down to earth. When we participated in that deal in 24, what they were saying then to what they're saying, now 16 months later is a very different story, and their willingness to try to work things out and make things work versus just letting everything kind of fall apart is very different.
Thank you. That's insightful. Sorry, Edward, for going on a tangent at the beginning.
While we're on that tangent, one thing I would like to emphasize is that people like to look at binary, right? It's either good, it's bad. This industry is very fragmented and nuanced. The next Curious Deal newsletter that will be published is a variety of types of deals. There's new development, there's vintage, there's a land deal, there's different markets. You have cap rates in the 3s in California and cap rates in Wisconsin in the 6s. And every deal and every market has their nuances and stories. Even you can have very different deals within the same markets, different counties, different zip codes. All this stuff makes a very big difference. And I think there's a lot of silly that there's a lot of herd mentality that we just kind of follow the headlines or we follow what somebody else is saying or what others are doing. And we get caught up in this just like mixing everything together. And there's so many nuances. I had a call with an executive from a student housing company, and they're fascinating because they look for the trend when enrollment drops. They then buy in those markets because they know there's going to be an upswing in enrollment, right? So a school that if their enrollment's down, they're not going to just settle and be like, okay, it's down, we're going to do nothing. They're going to make an effort to, so they're coming in when it's low, and then they catch it on the up when enrollment increases. And we're not in student housing, but that, to me, that's fascinating. And that's a very different story than, every other story you're going to read about multifamily. So I think it's really critical to understand the nuances. I'm curious. I don't know any of this stuff, so I want to know it. So I dive in and try to figure it out.
And that's also completely market agnostic strategy, right? You're just going on data. It could be random market, could be Champaign, Illinois, could be Wisconsin, and the student housing part.
Correct.
So are there particular markets you guys are?
We're based in Baltimore. The development, we've sold all of our stuff actually that we've had in Baltimore, the early stuff that the owner started with. We're hands-on, we're operators, so everything is local right now. We've looked outside of our market, but that was more of on a deal basis. So that preferred equity deal we did, that group had a portfolio of 1,500 units with the same situation that they wanted us to take over in Michigan. So we took a hard look at that, and our underwriting, even if we got to stabilization, is still underwater. We've had other situations where we've looked at a market based on things that have come our way. We just had annually we do this lunch with the CEO and people do a Q&A. That's always a question. Are we going to look at other markets? And, we're hands-on and we like to touch our properties and feel and manage them ourselves. So far, we've stayed local. We've looked at, and we have certain criteria that when something does come up, there's got to be ease of access in terms of direct flights or a drive from Baltimore, and the possibility to have a certain amount of units. Like we're not going to buy a 300 unit community somewhere where there's no potential for more if we're going to self-manage it. So we have a certain threshold of the possibility of growth there.
Fascinating.
And for those that aren't subscribed yet, you can find links to Moshe's newsletter and podcasts on the show notes. Moshe, let's talk about the state of multifamily. And so you wrote recently that there's high demand for good operators, and the supply of good operators is much lower than the demand. So define what a good operator means in 2026. What are they doing differently right now?
It's not a new thing that there's a high demand for good operators. I think what has changed is that the market has changed. So in 21, for a long stretch, it didn't matter if you were such a good operator or not, you were making money in this business. And when things get rougher, tighter, there's more challenges. So then, it kind of bears who's good at what they're doing and who's not. And it doesn't mean if somebody's struggling that they're a bad operator. There are people that are great operators that have gotten into situations that are not great. If you've been in any business, you're going to have wins and losses. The question is, are there more wins, or are your wins because you were good at something versus just good market conditions? So in terms of good operators, there's a big correlation, I believe, of retention, employee retention, and operating. And so you see, I've never been in the third party game. I don't want to be in the third party game. There's a lot of chaos happening in the third party game. There's a lot of churn. There's a lot of like Chinese fire drills of folks like owners making demands and everybody having to scramble. There's a better work-life balance. For your mental health, it's better to work for an owner-operator than a third-party management company in most cases. So the third party, think about it in terms of business or sports. Google, Apple, Meta, they don't have a problem of attracting talent. People want to go work for those companies. People want to go play for Duke, UNC, these top schools. In operations, in multifamily, this is not a dig on any specific company. Nobody's going to say, I want to go work at this company. And so they're all doing the same thing in terms of trying to attract talent. They're putting up postings and they're taking whatever they can get. And so it's a real big challenge in our industry in terms of talent and developing talent and just having people who are there. It's management operations is not for everybody, but for a group of people, and a lot of them don't even know it, it's a great career. I just had a call with an executive that hopefully is going to be on my podcast, who started with their company at 17 or 18. They're a top, I don't know, 20 operator. She's not even 40 and she's the president. And she listed the majority of the people in their company have been there for 10 plus years and all started on site and moved up. So the question is, what's a good operator? It's go to a sports team. You have a good coach, you have a good infrastructure. College sports is a great example because their players are going through, max 4 years, and many times it's 2 or 3 years. And do they have a program and a philosophy that almost no matter who they're putting there on their roster, they're able to be successful? So we like to think, maybe I have imposed that on Sage, but the West Coast offense, you don't need everybody to be an A player. You need to have a system that works, that you need the right person. You put that person into place. Obviously, there's a certain element of accountability and for them to make decisions. But the West Coast offense took maybe average quarterbacks and made them fantastic because it put them in, here's quick decisions. You don't have to have the strongest arm. You just need to be accurate and know what decisions you need to make and how to make them.
Goes back to the people. At the end of the day, it's up to the humans that
It's people and systems. If something's not working, you have a bad system. If something's working, there is a system. And yes, as long as the system is reliant on people, you need people to be within the system.
Yeah, and to that regard, in terms of what's going on in the third party world, I mean, it's not only affecting multifamily condos and co-ops, but also single family. I mean, in the last year alone, we saw Associa acquiring Douglas Elements property management arm. We saw ACAM acquiring Orsid, is, in my view, one of the best brands and manages great buildings here in New York City. But they also famously are proud of their quote unquote nepotism, but they brand it in a positive way where they have people that, like you said, may have started on site, moved up the corporate ladder, and people have been there for years, get promoted, are happy. And even those companies that are keeping, most of their humans happy and working in tandem in their system are seeing benefits in being acquired, whether it be because consolidation brings a lot of efficiencies, but also third parties hard. Incentives are aligned with ownership or with the boards. And on the single family side, pure property management has been rolling up, more recently merging with, I think it was Home River, forming over 40,000 units of single family rental. So truly the last year for third parties have been tumultuous, to say the least.
Yeah. So I'll just to go back up for a moment. Our company is completely different from and over the last 8 years, I think for the better. And it's not because of me, but it's fun and exciting to be part of the evolution of the company. And the biggest changes we've made is our systems and our processes for how we do things. The biggest change is how we set rents. But I'm embarrassed to say, I won't talk about how we used to do it. But I could look back and say everything changed for the better when we created this system for how we set rents and our philosophy for occupancy and rent and so forth. So we've been hyper focused on collections because the only thing worse than a vacant apartment is an occupied by someone who doesn't pay. And it's even worse if they're fraud and you can't get them out, or it takes a long time to get them out. So how we do rents, we have pricing calls once a week, and we have a system. They kicked me off those calls. But when I was on those calls, they run really smoothly in the sense of what we look at and how we do this. It's not very complicated. And you have certain goals, you're measuring it. Did you hit the goal? If you didn't, and then you're adjusting based on that. And we like to operate from a point of strength of higher occupancy. So we had bought a mismanaged deal when I had just started, 400 units, townhome community, rents were about 1,000. We were renovating it, getting about 1,350, but occupancy was around 80. We started by giving these high renewals. Again, if people are paying $1,000, a $250 increase is significant. Now, asset management say it's great. If they leave, we're going to replace it with someone paying $1,350. But a 400 unit community, you don't turn over in 12 months. And so we made the switch where if someone's paying $1,000 and they're a good resident, we're going to give them a modest increase, a 3%, $50, whatever it might be, keep them. We got to 95. And then that's when we started to be a little bit more aggressive. But these value add deals, which there's not a lot of value add deals right now because of the market, that you don't turn it over overnight. So we started spacing out the renos that we do, and we started doing them in stages and tiers versus coming in, renovating everything and trying to turn over the whole place in a very short period of time. And then in terms of our team, so if we were very behind the eight ball. If we had someone who was fired or someone who left, we were scrambling. Now we have a roving team, so we don't miss a beat. And if we do need to make a move, a staffing move, we don't hesitate to do the right thing where we did that before because we were always concerned like how long it's going to take to replace it. So now if somebody leaves or we need someone to leave, they're asked to leave, like we have a floating manager or floating leasing that can come in, and it takes time to replace somebody, but we don't miss a beat because we have this team. Or when we take on a new property, that used to be a huge challenge. Now this roving team could come in and we could hit the ground running because they've been with Sage and they know how we operate before. Like when you buy a new property and everybody on the property working on the property, that's their first day with the company, it's stressful.
That's really interesting. I love that idea of the roving team. You mentioned fraud prevention, tenant screening is important. What kind of softwares are you using for that in the business?
So right now, I believe we're using Snapped across the board. So we use Snap for document verification and ID verification. Do you want to hear the fraud story?
Of course, why not?
So during COVID, we were doing cash for keys. So we couldn't evict anybody. So we had this high delinquency report that would go out. And, the top 10, we were giving an offer for them to move out and clean their slate. And I had an epiphany one day as I was looking at this that we default to looking at the higher balance as a priority. And I wanted to make the shift that it was based on what rent we could collect. So if you have someone their rent is $1,500 and they owe us $10,000, is less valuable to get them out than someone who's paying $2,200 in rent that only owes us $5,000. So when I had this epiphany as I was going through this report, I was pitching to the team that everybody's not the same, and we should be viewing this more strategically instead of just saying, let's get at the highest balance in what we're offering them. And as I was doing this, I went down a rabbit hole by looking at the report. Bothered me why there were recent move-ins that were on this list. And then I started digging into those recent move-ins, and I have whole folders of them there was so many common denominators: out-of-state driver's license, jobs in other markets, and there were so many things. And when I went through this, I had, at that time, I think we were around 3,000 units. I had 10 residents that I was positive were fraud based on this and I had a whole file for each of them. And I brought it up that we had to do something. And the average owed us $5,000 or so, $4,500 or so. And I presented that, at the time it was checkpoint ID to start with, because it all started with fraud is they don't want you to know who they are because they don't plan on paying. And then it's really difficult to come out, especially when there's no evictions and so forth. And there's no authority agency to report them to. Nobody cares about that, which is another problem. I remember I signed up for checkpoint ID. And at one point people were delaying, we couldn't have a meeting. And I just did a screen share and I went through those 10 folders and explained. And I remember the CEO coming up to me saying, okay, we should move forward. And I said, great, because I already signed the contract and the tablets they sent will be here Monday. And I had the confidence in that because if you want to fire me for making that decision, I could live with that But yeah, so that was the first step. And then it became part of our regular weekly reporting. We would look at new move-ins and at people who had a balance. So eventually we switched to Snapped because we saw this trend at a certain property where there was recent move-ins that had balances. And then we realized that just their ID wasn't enough and we had to take it to the next level. And one of the deals, which is that I'm going to give an investor update in the newsletter about how it's performing, is one of our best performing deals. It wasn't a value add deal. A lot of it was cleaning up the bad debt and the fraud that the previous owner had.
Fascinating. And going back to your roving team idea, I think it reminds me a lot of a football team in England called Brighton and Hove Albion, who are a selling club by definition. They buy young talents for low and sell high to the larger clubs, but their model is to keep selling their best players every season. And the only sustainable way of doing that is to have 2 or 3 replacements ready to go for each position. And they, keep being in the top 10, even top 7 of the best clubs in England. And they're happy. They're super happy selling their best player every season because they have 2 to 3 replacements ready to jump in. I like the Moshe, Crane, Sage, Brighton way of doing things from a team perspective.
We are not selling our employees.
Not yet, at least.
Only in soccer does that work still. Any other sports where you actually buy the contracts like you do in soccer?
I mean, traffic humans from company to
Yeah, it's
company.
basically, it's unbelievable. Business is still done like that in soccer.
And I mean, the announcements, like I'm waiting to see the news of breaking news. Moshe Crane sold to Metaprop consensually or sacked. Moshe Crane
Yeah, I mean,
reign ends at Sage Ventures.
I guess in M&A deals there are like contract buyouts and stuff of executives, I feel like, but that's sort of the closest thing you
But
get.
we should announce them like that, proud.
When I was doing real estate development, we had a similar thing. We had a team that was really just the development team, and they would work on whatever the new asset was at the time, and then they would gradually sort of pass off and recruit. Part of their job was recruiting the people who were ultimately going to be running the building at the property management level so they could then go on and try to tackle the next development project. But it was like, yeah, stuff takes time for sure.
Yep. Moshe, let's talk a little more about your role at Sage. I mean, you have marketing, you have strategic initiatives. That title sounds a little soft, but it's not. It's not at all. So, what does that actually mean inside a vertically integrated operator? Are you focusing on the capital relationships, the market positioning, pipeline strategy, or partner selection, or a little bit of everything?
So for the first 5 or plus years, I was the director of leasing and marketing. Whatever, 2.5 years ago, when I was put into this position, they created the position for me, and it was, we want to leverage your network, and everybody's heads down operating, and my job is to be heads up, networking with other operators, other suppliers, finding out what we should be doing to get better, and finding relationships and finding opportunities. So I get involved with the acquisitions team. Most of my work is reporting directly to the president based on this is the things that I'm seeing and hearing. And, I'll make suggestions of initiatives. And then, if he wants to go forward or not, or sometimes he comes to me and says, go figure this out for us. So in terms of the branding, it just happened, I would cut myself, I would bleed blue, Sage Ventures blue. So I'm not trying to leverage the company and prop myself up or, it's funny because in my career, I've had some interesting situations, and there were times where I was hoping to get recruited somewhere else, and that I thought I would go somewhere else. And, there was some shifts that happened, and part of that was this position and how much I enjoy what I'm doing, and I love it. And after that, a few people did come to me with offers, and I said, if you would have called me 6 months ago, it'd have been a different story. But, you know, nothing personal. You can't replicate what I'm able to do here. And I get to participate in a lot of things. I get to participate in, we're doing development, we're buying, we have office, we have self-storage. There's so many elements of real estate to be exposed to and be a part of, and it's a lot of fun. The newsletter just started by, I'm doing research on our markets, and then I noticed one day that my subscription to the data thing that we had was outside our market, and it was the entire country. And I just started doing research further, and I would share my insights, and started as just LinkedIn posts. And I was like, why don't I do this on Substack? And it was once a week, and now it's 3 times a week. And the CEO subscribes and he sends me comments on my newsletter, and it's a lot of fun. So branding, I do corporate marketing. So I run our LinkedIn, the stuff that I do, I work for Sage and I'm on this podcast. I work for Sage and I have my own podcast. That's known in the newsletter. I talk about Sage deals. So there's a good synergy between myself and the company and what I'm doing.
This episode is brought to you in collaboration with CREtech, one of the most valuable events I attend each year. It's happening on October 20th and 21st at the Javits Center in New York City. Whether you're a real estate owner, developer, investor, occupier, or tech leader, this is where business gets done. I've had the chance to grow real partnerships and discover tech solutions here that I might not have come across otherwise. And this year, CREtech New York is back with CREtech Meetup, the one-on-one meetings program that will deliver 20,000 pre-scheduled meetings. Designed for qualified real estate professionals, the program covers your full event pass plus up to $800 in travel and hotel costs. All you need to do is choose one-on-one meetings with tech companies that match your business needs. It's a smart, low-pressure way to explore what's out there. without the typical event costs. If your company owns or manages 1,000+ residential units or 1 million square feet of commercial space, and you're involved in tech or operations decision making, this is definitely worth checking out. Learn more in the show notes and see if you qualify by reaching out to us at community@tangentproptech.com. I'd love to hang out at the event as well, so feel free to reach out on LinkedIn. Now, back to the show.
Truly priceless, and you can tell you love what you do. And I mean, I'm just wondering what the president thinks who will be the roving team if and when one day Moshe isn't there, but that's a question for a different time.
Roving's for on-site. I do visit on site. I need to do more of it, but I'm not working on site.
It will have to be a human robot in 10 years, maybe. If you strip out the noise, I mean, what are 2-3 things that Sage is obsessing over in this cycle or focusing on? Is it cost discipline, operational margin, debt structure, selective acquisitions, as you hinted at before?
So we've been very disciplined about what we do. So a shift, I said that we accidentally got into self-storage. So we bought a office building for the land. It's in Aberdeen, Maryland, about 30 minutes north of Baltimore. The office is an office building, 4 stories, 100,000 square feet. It was built, but they like just the exterior, the inside was all raw. And we bought the building for the land to develop an apartment community, which is now 522 units, Fieldside Grand. And the question was, what do we do with this building? And we went through a lot of different options. It didn't make sense to have 100,000 square feet in 4 stories of amenity space. Converting it to apartments didn't make sense. And the one thing that seemed low risk and why not was to convert it to self-storage. And we did that and it worked, and we recently sold it. So during this drought of not being able to make multifamily deals work, we bought 2 office buildings next to each other, about 50,000 square feet each on 95, not far from Aberdeen. One was 100% vacant. We converted that to self-storage. That's working. We actually are in a phase 2 where we're adding another 50,000 square feet to that building. And the other one we kept at its office. At the beginning, we didn't really do much with it. Last year, we've had a fair amount of leasing activity. Again, it's a smaller property. It's 40 to 50,000 square feet, but we went from 22% leased to 88% leased in 25. And then that opened our eyes to this thesis that we have on office, that even though the demand the occupancy is low and office is struggling, again, in core markets, there's still a high demand for Class A space, and a lot of owners don't have the money to do a deal. So if you lease 5,000 square feet in some markets, core markets, that could cost you $500,000 in TIs and commissions, which is a lot of money just to lease 5,000 square feet. So our thesis was that if we could come in at a lower basis and we could be capitalized to do deals, there will be opportunities. And so far, thank God, that has played out. In June 25, we bought 400,000 square feet in Falls Church, Virginia. It was about 70+% leased, and we've added like 15 to 20,000 square feet of leasing in the 7 or 8 months or so that we have. And because we came in at a lower basis, it was actually cash flow positive day 1 for us. So I think we're going to buy a ton of office? No, but we are continuing to look at office. So we did 2 self-storage conversions. We did a ground up self-storage development in Columbia, Maryland, and we're looking at more of those. And multifamily is coming back in the sense that the possibility to do deals. And it happens to be a lot of the stuff that we're looking at is this preferred equity where people don't want to sell at too much of a loss, so they want to work things out. And then the development, the state doesn't make it so easy to develop, but there is a shortage of single family homes. So we've been buying land. We do the entitlement work. Those things take a long time. We have a few deals that are coming up, and then this development deal. So we're scrappy. We have an entrepreneurial spirit. If I would have told you 3 years ago, would we be developing 316 units in downtown Baltimore? No, but when you come in at a significantly lower cost basis. I think the previous owner bought the land for close to 10 to 12 million, and we just bought it for 2. That changes a lot when you can come in at a much lower basis. And because we have our development arm, like we're managing this project in-house, the construction part. We're creative and we like opportunities, and not just me, but the owner is very good at visualizing things that don't exist and being creative to put things together.
You certainly, I mean, the ethos, the culture of the company certainly sounds a lot more entrepreneurial and even in startup-y first, and real estate operators second, not less prioritized, but more in the way you approach deals and how you plan. I mean, curious how you explain that to investors, and I'm sure you have very smart and happy investors, or is it all in-house that you use? But you're playing with the cards that you're dealt, right? You don't control the interest rates. It depends where the interest rates are and where we are in the cycle. It makes a lot of people feel or look smarter in retrospect than they are, and vice versa. You know, not everyone is terrible where when the macro isn't as favorable. But how do you get your investors comfortable with a strategy which is we're passionate, we're good at what we do, and if we haven't done something before, that doesn't mean we won't be amazing at doing it now because we have the right elements in place and the right conditions to execute.
There's a lot of folks online that have very similar headlines on their LinkedIn profiles, helping people make passive income, escaping the 9 to 5, all these things. Do a search on LinkedIn, you'll find thousands of profiles like this. And they post a ton of content. I'm curious about those folks. I've signed up to be an investor or whatever, and I've gone through listened to their pitches, and they have all sorts of things. And I ask questions, and often their response is nobody ever asks us that, or they don't have a good answer, whatever it might be. And I'm not saying this for everybody. There's folks that happen to be very out there that post a lot of content that are telling a certain story. And I know people who are in their deals and they're not getting any distributions, but they keep buying deals. I'm obsessed with looking at signals and seeing patterns. And the owners that I know, the real investors that I know that are successful, this is not a knock on anybody. It's a pattern that I've seen, are not selling courses. They're not doing masterminds, and they're not doing some things. So it always begs the question, why are these, if real estate is going so well for you, why are you doing this? Our owner loves to go skiing. That's what he's doing. He's going skiing. He's traveling with his family. Like, he's doing those things on his free time and not having these mastermind courses, things to make a buck. And he puts his own money in all the deals. And some of it's a significant amount. So are there people who are not comfortable with what we're doing? Yeah, it's not for everybody. When we went to office, there was a lot of investors that were like, we trust you. We're very transparent. We're not we didn't have any floating rates. This is not a knock to anybody who was. I don't know. I'm not going to pretend to understand that I could have predicted that was something you shouldn't have done. But he had a lot of pressure to take floating rates when it was extremely low. And he said, no, fixed rates. We stayed this way. So are we promising the craziest returns? No. We're focused on executing at a conservative, like, we believe in this business. We believe in, investing and doing this. And so there's a pretty solid, loyal group of investors, of LPs, that trust us. Other people who are nervous, and there are people who won't invest when we do a deal there.
Yep.
But there's also that, like, they trust, and we have deals that are doing, thank God, really well in that county. And we just bought in that county, and we're looking at other deals in that county. So in the sense, like, we're not trying to convince people to do something they're not comfortable with. We're not trying to convince them of, that's part of why my role works well, because the owner doesn't want to be in the limelight. He doesn't want to be out there. He wants to operate, look for deals, raise money, and have a good time with his family and travel. And he's a religious man, and he spends a lot of time studying. He's not creating a ton of content. He's not hosting these masterminds. He's not selling courses. There's a lot of relationships, and there's an element of trust, and we're very transparent. Like, a lot of those folks where they're posting, if you look at what they post, they don't actually tell you how the deal is doing. They tell you, we bought this and the rents were here and we've renovated. And by the way, we don't do renovations in-house. If that's a conflict of interest, I'm not here to tell you that, but we don't do renovations in-house. And you have these groups where you're doing a value add and you buy it and they're making money on the turns, and their turns are expensive. You're talking about $15,000 a unit, and they're the ones who are doing it, and the deal's not distributing. And we've explored.
That's a good point, right? There's something to be said that there's accretion to be had from vertical integration, but also there's misaligned incentives potentially if you have a separate company that you also control.
And we explored that. We explored, creating a painting company, because we're spending a ton on painting and turning units. And at the end of the day, we didn't want to have this tag that we're doing something we've been very disciplined in sticking to what our core business is, and not getting distracted by other stuff. Could we be losing out on some of that? Maybe, but I think overall it's been very good and healthy to be disciplined, to stick to our core business and what we're good at.
Do you think that will change now in the age of much cheaper building in-house versus hiring external third party or buying a company? I mean, because there's a clear distinction between like services that are still very much performed by humans, whether it be the renovations or other services that properties need. But when we're talking about technology, in our recent podcast, you were discussing how a lot of the companies now will maybe think twice before going and hiring a third party or buying up a company, because now building in-house may be cheaper, faster, and ultimately better aligned. So do you see that changing in how you do things?
So one of the things I started doing is because I spent a lot of time talking to other people. I started doing these emails to the owner and the executive team about the things that I'm seeing. It's bullet points. I'm seeing this, I'm hearing this, two, three. As an example, we were talking about companies acquiring management companies, and I sent an email about that, and he replied back saying he gets calls from private equity companies all the time trying to buy our management arm. The next email that I'm going to send them, which will be today, will be about one thing about this idea of building tech internally, people hiring these AI consultants to say, this is what we want to do, and them helping them figure out how they can build that on their own. Also outsourcing talent overseas for accounting, admin stuff, back office stuff, things like that. So those are two topics that I'm going to be sharing on. And so we'll see how they respond. My job is to share the ideas, and then it's in their court to make decisions what they want to do with that. A lot of fascinating things happening in the prop tech world. And I'm not a prop tech expert, but I understand that there is this prop tech ecosystem. And there are groups, again, will people call this a conflict of interest or not, where you have these third-party management companies are investing in a fund that are investing in these tech companies, that they're now using those tech companies, whether they're the best product or not, because they're also making money at the scale that tech company is being deployed across their platform. So the old way in the past was you had the Yardi, RealPage, big property management companies that would acquire these smaller services because it makes it easier for operators. We'll just bundle it. And you could, instead of going to hire and vet all this other tech, hey, we could do that for you also. So the first shift that I've noticed in the last 12 months or so is that you're having these I think I actually got this term from Jeffrey Berman about how like you have a platform, a hub versus a product or a service. And so a property management software is a hub. I don't think you use the word hub. Maybe it was a platform. And so now you're having these like micro hubs, right? So maybe you have an access control company, and now they're acquiring the different people that fit into their world.
Point solutions versus, yeah.
Correct. So there's M&A that's happening in different spaces than the usual, right? So there's over here, the nucleus, and now you have these like islands of groups that are acquiring. But in terms of tech, so now I think what you're referring to is I posted this clip on LinkedIn, was that number one, the speed of technology that's advancing, these companies don't need to acquire anymore. They can just say, hey, we want to build, right? Elise AI can now be a CRM, and before you know it, there'll be a property management software as well. Also, I like to think of things in full cycle. Marketing in our industry, I would venture to say, is about $4 to $5 billion a year as a market of what's spent. I took our average marketing spend per unit, and if there's 20 million or 40 million units, whatever it is, and you multiply that, you have this marketing spend of $4 to $5 billion. Apartments.com is a quarter of that, right? They're a public company, they're $1 billion. When you have a ton of money and there's a significant leader, and all they're doing is demand, they're creating leads. There's no websites, there's no nurturing, there's no this whole thing. So I think there's a huge disruption coming for marketing. Well, it will happen or not, but the opportunity is there. So the way I would think of it is the full cycle. You're a platform, you're a service product, you're a hub of, you're not just an ILS, but you also are then the website and the conversion tools of those leads that are coming to the site and nurturing it. And it's a full cycle versus think of how many different products or services that you're dealing with. You have 3 ILSs that you're using, or maybe 2, and then you have it. You're probably getting your property site from your property management software, and then you have an agency that's doing your ads, and then you have this product to nurture your leads, and you have another product that's a bot on your site, and that's a lot of stuff, and it's clunky.
It's truly a remarkable time to be at the intersection of real estate and tech with the rise of AI, which I was going to ask you about. But before that, I'm very curious to hear what Zach thinks about what you just hinted at when it comes to if a property management company invests in a fund, which a fund then invests in a startup, and then call me skeptical when it comes to that LP, that property management company, then automatically adopting that technology. Because in practice, I mean, being on the tech side, I wish it was like that in many cases, but I'm curious to hear what Zach thinks.
Yeah, I mean, it's usually different departments at that org doing it, and the way we handle stuff like that, like the people at the ground level who are using whatever software it is, we were talking about fraud detection before, right? Like it's ultimately their decision what they use. And we've always advocated, it doesn't always happen, but we've always advocated for people to still do a bake off and get, 3 proposals, even if you know that one of them, your company has incentive to make more successful than the others, and figure out what works best for you and the NOI of the particular assets that your division is running. So I haven't seen a lot of that kind of behavior where it's, oh, we just invested, so now we have to use it. I definitely see a lot of sort of C-suite executives getting really excited about something, investing, trying to push it through the organization. If it's not good or they don't like it, it kind of dies from a usage perspective. At the end of the day, it's the mid-level people who run these organizations, and if they're not excited about using it, it's not going to happen.
Do you see a correlation in terms of like how early in the development of said technologies and when they involve that LP or potential user in terms of, developing this for their benefit, like according to their needs, solving their issues versus coming to them, it's like, hey, we have this, use it.
We've seen a lot of different situations in the past. We had a company that signed up one of our LPs as a design partner, and then they had other design partners as well early on in the iteration of the software, and they concluded that the product they were building was not at all relevant for this particular design partner during that process. So it was sort of validating in a disqualifying way. I think even if there's an investment directly in the company or an investment in the fund that then invests in that software company, there's always a contract negotiation in between design partner, pilot phase, whatever you want to call it, and actually rolling out a contract. It's certainly not guaranteed by any stretch of the imagination to happen. Because again, there's a difference between testing something out and actually deploying it and rolling it out. What I will say is like the appetite for not just testing out different software solutions, but trying to build their own agentic workflow on some sort of application layer AI platform or directly in the foundation model as well. The technology's just gotten exponentially better over the last few months. We're seeing way more of that. And that was a big impetus for us to spin up Metaprop Labs and start actually getting involved in the agentic workflows that a lot of real estate companies are coming to their own conclusion that the technology is now there where they don't have to buy software specifically. They can not necessarily vibe code their own solution, but work with a company to develop something very specific, not unique, but very specific to their workflow and how they like things at a fraction of the cost of what it would cost to bring on a new SaaS provider for that function, for example.
To be respectful of everyone's time here, we have 6 minutes left, but we still have so many questions for Moshe.
We should do another, can we go on your podcast? I don't want to be presumptuous, but we got a lot of more shit to talk about.
So much.
Yeah, we could talk about it. You could apply. No, I'm just kidding.
I made a or we'll have you on. We'll have you on this one again because we only got to like half of it, and we got to do collaboration superpower.
Yeah, okay. We gotta do. Zach prepares for that all week. We could do a quarterly one. So. Quarterly Moshe would be a pleasure. Just before collaboration superpower, Moshe, you're a curious person. You're passionate. You're kind with your time. You come across as genuine and also ambitious. I mean, what motivates you? What inspires you? What drives you?
Good question. There's a lot that has shifted for me the last few years. I would say the biggest change was leaning into my curiosity. So I was struggling with various things at work. I have ADHD and I was frustrated. And I remember wanting to do something, and a guy said to me, a friend, that he said, I will not talk to you about this until you read this book. I don't read. So I figured out how to get the library app on my phone and listen to the audiobook. And that book was the beginning. So the book was Measure What Matters about OKRs. And that was a huge shift in how I view things. Beforehand, it was like you have a goal. But then when you take a step back, be like, well, what's the actual objective? And then the key results, what are the ingredients in order to get that? And I remember that was, I'm a religious person. I believe that everything comes from God. And it was bugging me where like I did make a change, and things are getting better. And people would ask me like, what's different? And I was like, it's not because of me, but I did happen to read this book. And I remember talking to my rabbi about it. And he's, who do you think sent you the book? And so that was the beginning. And it was like, what else can I learn? And at that time, I would listen to some podcasts, and sometimes you get good stuff and sometimes you don't. I guess it depends. And I started just listening to more audiobooks. I want to learn about this. I want to learn about that. I would listen on high speed, and I spent a fair amount of time in the car spending, because I would drive to properties and spend more time on site. And I was not good at school. I was never the smartest in the room unless I'm in the room by myself. And one of the books that I would listen to was Patrick Lencioni. I listened to a bunch of his books, and the ideal team player and core values of being humble, hungry, and smart. And so I'm not the smartest, I'm not the most successful, but I try to be the hungriest in the room. And I've leaned into that and I live by that. And to be humble, like whatever I'm capable, like everything we're good at is a tool that God gave us. And the things that we're not good at are also like we have good tools and we have bad tools. And so I've leaned in on the good tools that I have. And I remember making a shift. There's certain things that I'm not good at. And I was like, I'm going to be so good at the things that I'm good at that it will ignore, not that I don't have to work on those things, and I do work on those things, but I go on the offense of trying to be so good at the things that I'm good at. And the worst thing that happened when I started at Sage is I wasn't given a lot of direction. And so I would try to figure things out, and then I would ask questions, and I didn't like the answers. I would like really research, and which I'll finish off with. When I started, and still now, I don't fully understand like the whole financial part of our business with the debt and CMBS and loan. And I think there's a huge opportunity. One of the books that was a big impact on me was The Big Short. And it's like, how is this happening in our industry? It's wild, wild what happens on the financial part. Like when you do a refinance, what if they look at a T3 or if they look at anything, it's mind boggling. And the biggest indicator for me when things were shifting was these groups from north of Baltimore were coming down and bidding on the same properties and significantly overpaying. And it's like, who's approving it? Like who's lending for this and why? And it doesn't make sense. And the disconnect, there's a big disconnect in general between corporate and on-site. There's a huge disconnect between these lenders and these brokers and what actually happens in on-site and in markets. And I think that there's a huge opportunity in terms of tech solutions, transparency, data for the financial world in terms of the lenders, underwriting, so forth. And also we talked about people at the core of this business. Whatever happens with technology, you're not going to eliminate people in this business. And the aspect of technology focused on people is minimal. I'm talking about like hiring, training, it's developing talent. We were talking about like, it's wild that there's zero focus on that.
So much to unpack there. All I'm gonna say is so many people, so many companies try to like or obsess over their weaknesses and try to sort them out, but you just gotta double down on your strengths. That's where you'll have the
And I've
ultimate
learned to
value.
love rejection. So as I started, and I
Oh,
literally started posting on LinkedIn because I figured if I put myself out there, more people would be willing to talk to me. I think more people are willing to talk to me. There's definitely people who are not willing to talk to me because of what I post, but fine. But there's a lot of people who totally ignored me, and I remember that. I don't want to be that person. So I try to be the person that I would have wanted earlier in my career to other people.
for what it's worth, I think you could sell prosciutto to a rabbi, but
Say that again.
I said for what it's worth, I think you could potentially, I mean, I'm not saying you want to, I'm saying you're that good, that communication, that curious, that humble, that ambitious that you could sell prosciutto to a rabbi. Collaboration superpower. Zach, if you could choose one person, historic or living, to do a partnership with this week, who would it be?
Bill Walsh, the inventor of the West Coast offense, legendary football coach, invented it I think in the 60s and 70s, even before he became famous when he was still an assistant coach. Won a bunch of Super Bowls.
It literally turned around. I don't know what, I think it was the 80s, the San Francisco 49ers. Like they went from the worst team to winning the Super Bowl in, I think, 2 years.
Boom. Moshe, where can Tangent listeners, developers, investors, course sellers, and people in real estate tech learn more about you, Sage Ventures, and connect with you?
LinkedIn, I'm there. And some of those people you just listed are definitely ignoring me and don't want to talk to me, so they're not looking to find me. But yeah, I share a lot on LinkedIn, and I do have a podcast, Curious Wire, and my newsletter, Curious Deal.
Moshe Crane, writer of Curious Deal, host of the Curious Wire podcast, and VP of Sage Ventures. Thank you so much for coming to Tangent today and sharing your background, your wisdom, and your vision with us.
Muchas gracias, and thank you for listening to this episode of Tangent Proptech. If you learned something new or enjoyed the conversation, text a friend the link to this episode right now. You can find links, resources, and ways to connect with us in the show notes, or reach out anytime at tangentcommunity@gmail.com or on LinkedIn. We love interview suggestions, topic ideas, or just a friendly hello. We'll catch you next time, and remember, the best PropTech ideas usually start with a tangent. If you're building something impactful in real estate or tech and want to reach our audience of decision makers, investors, and operators, email us tangentcommunity@gmail.com.